August 3rd is going to be a big change in the condo market. Please take a moment and listen to this. I think it can really make an impact in your business if you're in the real estate business or if you are a condo owner and you want to understand what's happening on the lending and financing side of the condo market. So let's just to recap what's happened. The state had a mandate where they wanted a milestone report and a structural integrity report for the buildings to be safe. So over the last few years, the milestone reports determined if there was any structural damage, and there was assessments put on the owners of the condos to be able to keep the building safe. Then they did a SIRS report, which is a reserve study to make sure that the building stays safe over time. So a lot of owners experienced an assessment, and they also experienced an increase in their association fees because they have to now mandate, the association had to mandate these new reserve requirements to make sure buildings stay safe over time. That's what's been happening. Now, that's had some impact on lending because now the lenders, we wanted to make sure, is the building safe? Are there any structural critical repairs? What's going on with the building, right? So there was additional questions we started asking. Well, one of the things that we've had a high success rate is being able to use a limited review. On August 3rd, the limited review is going away. What the limited review did for us was when a buyer had a certain amount of money down, we were able to eliminate the budget and balance sheet so the building did not have to meet the Fannie Mae and Freddie Mac's requirement for reserves. That's what the limited review did. It was a limited review on finances and it had some reduced questions. But now that's going away. And not only is that going away, but in January 2027, they're changing the reserve requirement from 10% to 15%. So what that means is, let's say it's a large building, just for sake of simple numbers. Let's say the building's bringing in $1 million a year in revenue. We needed to see $100,000, 10% going into reserve as an allocation into reserves. They're now saying they want $150,000. So the reserve requirement is going up. Well, that's a big change, and a lot of association presidents, contacts, and members don't know of those changes. But here's the other piece. The other piece is Fannie Mae and Freddie Mac have also reduced some of their restrictions. They don't have an investor restriction anymore. More investors can own in buildings, but also they are reducing the amount of insurance that the association needs to carry. One of the larger costs for an association to carry was full replacement of their roof and in their insurance policy. Well, now they're allowed to have actual cash value, which means that they can hold a depreciated premium based on what the age of the roof. So they're not having to replace the full roof. They're assuming that the association will have some reserves to replace the roof in addition to the insurance policy that they can carry. From what I'm being told, that can be a pretty substantial difference in the insurance premium, as well as they no longer need to hold inflation guard. So when you reduce the insurance coverage, hopefully there's not such a large increase in what they would need to carry to increase their reserve requirement to the 15%. This could be a significant impact in the association's ability to keep a building financeable and keep more buyers able to come to that building, keep it more sellable and more marketable. These changes, they're coming. And actually some of them are already here. The insurance changes are already available. So it's important that we understand this. It's important that we get it out to the market and teach our condo association members how to keep our buildings financeable, how to keep them marketable, and how to keep the values leveled. Because if they don't do that, there's going to be less buyers able to buy in those buildings. So this is a big change, and it's very important that if you're unfamiliar with the condo market, you're not sure how to get these buildings sold or what to do, please reach out to us. We can meet on a Zoom. I can go over everything with you. You don't even have to leave your house. We could do a quick 30-minute, 45-minute Zoom. I can educate you on these changes. And once you know them, you will be surprised at the opportunity that there is. Because when you help an association keep their building financeable, you become their resource. And there's a great opportunity for referrals with that and also to farm that building. So please utilize our expertise. We are drenched in this right now. We know exactly what's happening and how to keep buildings financeable. We have non-QM and non-warrantable options for a lot of buildings that may not meet Fannie Mae and Freddie Mac's requirements. So I just strongly encourage you to take the time to learn this. It's important because our buyers need this inventory. They need it. Even though the association fees are a little higher now, well, in some cases much higher, the prices of condos are still much lower than single family and attached single family. So overall, it's more affordable in a lot of cases for buyers. So if we don't educate them, our associations, and get our buildings properly prepared for financing, we're eliminating that opportunity for inventory. And I really believe we have a responsibility to do that right now. So I just wanted to come on here and explain what's going on. Our condo desk is ready, willing, and able to do everything you need them to do to help understand what we need to get a building financed. They have taken so many buildings from the Fannie Mae unavailable list to approved. So we know what we're doing. We know how to work this condo market and help our buyers and sellers. So please reach out to us if you have any questions. I am in the information below, and it would be our pleasure to connect with you and help you through this time.